So again, this is the 1031 tax deferred exchange for Massachusetts real estate continuing education 27 RC07. We have updated their PowerPoint with stuff that we feel is necessary, as well as the new tax changes from 2017. So this is everything. So I'm going to let you just kind of stare at this for a little bit, because this in a nutshell is the 1031 exchange. When Jenny and Michaela send you the PowerPoint, this is what you want to print. This is what you want to have on your desk. This is what you want to have available when somebody is talking about a 1031 exchange. Basically what happens, and we're going to drill into this a lot more, but this is the overview piece of it, is when you sell the property, I'll let Colleen in. So when you sell the property, right, we're calling that the relinquished property. And a lot of times the IRS has different language than we do in the real estate world with respect to exchange. We're going to talk about exchange instead of sale. We're going to talk about relinquished. We're going to talk about all sorts of different IRS type of words, but we're following their code because that's what it is. We're exchanging an asset. It just happens to be real estate. So from the point in time that you sell or relinquish the property, you have 45 days to identify the next property. And then you have, with that same amount of time from the date of closing, you have 6 months, 180 days to then replace that property. So you'll see the circular graph where the taxpayer relinquishes the property to a buyer, takes that money, puts it in the hands of an approved QI, which we're going to talk about. What is an approved QI? We'll talk about that. They'll hold that money and then they'll deliver it to the seller of your new property, right? So it kind of goes in a circle. Money is being held for your benefit. You, the taxpayer, do not get to touch the money during this period of time, but it's being held for your benefit. And then it is delivered to the closing attorney of the new property. Okay, so you don't get to touch it. We call it constructive receipt, which we'll talk about in a minute. So what is a 1031 exchange? So we're talking about IRS code section 1031, right? That's why they call it a 1031 exchange. But what happens is, whoops, didn't mean to do that. No gain or loss shall be recognized on the exchange of real property held for the productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in trade or business or for investment. So it's a way to defer paying taxes on the sale of an investment or business real property. So what does that mean? When you go to sell a property and it's not your primary residence, and we could talk about the primary residence exclusion also in this, but if you go to sell a property, there's typically a gain. There's typically a taxable gain, which creates a taxable event whereby the owner of that property would have to pay taxes. The 1031 exchange is a vehicle that allows you to defer that, to use those funds that you would otherwise have to pay to Uncle Sam for taxes. You can use those funds for another purchase so long as it complies with this section, right? Any questions so far? All right. So here's the history of the 1031 exchange. So it goes way back. Whoops, I keep doing that when I keep trying to move the pictures here. Let me do that. All right, cool. So the history of the tax deferred exchange, right? It goes all the way back to 1918 and 21. And then in the 70s, it actually started to take use. But what they were doing before 1970, it was a straight swap. So it was really hard to do a 1031. You actually had to find a buyer who was looking to buy your property and you were looking to buy theirs. So it was a straight swap. So you can imagine that is so rare that it was really challenging, and there wasn't a lot of these exchanges that happened. And then this Starker exchange happened in the 70s, where this gentleman by the name of Starker had a tremendous amount of property, put them all in a pool, sold them all, and had people identify where he wanted to buy them. The cases, went back and forth, and they decided what he was doing was okay. But then in 1989, they really solidified it. 2017, the Tax Cuts and Jobs Act, which had a lot of other tax incentives for taxpayers, along with the Opportunity Zone Fund, was created during this 2017 act, but it focused only on real estate. So there was some confusion of what other things could be exchanged, but the 1031 exchange is now focused strictly on real property or real estate. So it applies to business use and investment real property. So what does that mean? So if I am starting a business and I buy the real estate with that business, that would be okay. That's a property that can be exchanged. Buying a 3-family that has rental tenants in it, that complies, right? It also includes land, which I wasn't aware of until I started teaching this. So you could actually land bank a development and hold on to it for the business purpose, for the speculation of potential development in the future. It provides a safe and legal procedure for rolling these sales profits, right? So your gains into a new property as a non-taxable event. So in essence, what you're doing is you're getting a 0% loan from the government, right? So say you're about to pay $80,000 in taxes, but you get to use that $80,000 for your next purchase. That's money that you get to borrow from the government. Again, it's not forgiven. Those taxes will still come due at some point, but they're just not due right now. And you get to use that money. So the theory being is that you can stay in the game, you can actually level up and create a bigger portfolio, and the government is kind of your partner with it. Now that's for now. There is, I don't know if you're paying attention to what's going on in Washington, D.C., but this is on the chopping block with the capital gains increase that they're going from what we'll see here is 20% all the way up to 39% in capital gains. They're also talking about eliminating the ability to use 1031 exchanges. So, in a year or 18 months from now, this may all be moot. I'm hoping that that's not the case, because this is extremely beneficial for everybody, really. If you think about it from a socioeconomical, macroeconomics viewpoint, you would see that, you're helping this investor do more for society, right? So if they're taking a 3-family and converting it to a 6-family, they've created more housing stock as well. So I hope they don't get too short-sighted and eliminate this. I will say this, these are hard to do. I've tried 2. I failed on the first one and almost failed on the second one. I'm closing on the second one on Friday, and it was an absolute roller coaster ride, to the point where I finally made the decision that the taxable amount that was going to be due, it was worth potentially not buying at the best price possible because of the difference in the taxable amount. But the timeline, although it's 6 months, it goes by fast if you're trying to deal with town permitting and stuff like that. So I definitely would caution that this is not for the new investor. Like, this is for savvy investors for sure. So what is boot? Boot is an interesting concept. Again, I wasn't fully versed in on what boot was until I started teaching this, but I was always under the impression that if you sold for $720, you would have to buy something for $721, no matter what. But boot is an opportunity to say, okay, I'm selling for $720 and I'm buying for $520. So that $200,000 gain, or the portion of that $200,000, which may get flexed in with mortgage and other capital expenditures and such, that can be taxed. So you don't have to use it all. You can do a partial, in essence, 1031 exchange, where part of that money gets deferred and part of it gets paid. So it's the part that's not being exchanged in like kind. So it's taxable to the event that there's a gain on that. Okay. Constructive receipt is, and again, I told you this was going to be a tax class, right? Constructive receipt is what we were talking about with the qualified intermediary. So what's the qualified intermediary? It's better to explain that too. When the first property is sold, the funds go to the qualified intermediary, and that's an individual. It's a fiduciary that holds the money because the taxpayer can't hold that money. Otherwise, they would have received that money. Therefore, a taxable event would happen. So if they don't receive the money, then they don't have, I'm letting somebody else in, Kayla. Excuse me. If they don't actually receive the money, then the taxable event doesn't happen. But there's a lot of rules around how that money has to be held. So a qualified intermediary is typically an attorney, typically an accountant, sometimes a tax attorney, but it's somebody who's not involved in the transaction. So the attorney, the closing attorney can't be a QI. The seller's attorney can't be a QI. It's somebody separate and distinct. A lot of times it's folks that this is specifically what they do, and this is all that they do, right? So we're going to talk about where to find those people and who they are in a little bit, but they have the receipt of the proceeds. So you, as the taxpayer, you sell the property, those proceeds go to the QI. So you have constructive receipt. They're your proceeds technically, right? But you don't have the ability to touch them. You don't have the ability to use those funds. Does everybody understand that? Direct deeding is important because it gets a little complicated. Go ahead. So direct deeding is something that we need to understand because.
Wait now, what is the story with it? What's the backstory?
Oh. All right. All right. Direct deeding, whoops, is the deed still goes from seller to buyer. Even though there's a qualified intermediary in the middle, they don't take title with the exception of a couple of things we're going to talk about here with rehab and reverse exchanges, right? But direct deeding means that when the seller sells it, their deed is going from seller to buyer without referencing a qualified intermediary. So on record at the registry of deeds, nobody could see that this was a 1031 exchange. There's no reason to let them know that, right? Similar to, has anyone ever done a relocation deal where somebody's relocating? Sometimes those relocation companies take title, sometimes they don't. Sometimes they're simply power of attorney and they're handling everything and they have the deed in their possession going directly to the buyer. Sometimes they actually buy it from the seller, coordinate everything, and then sell it to the buyer. And when they are direct deeding it, it's similar to this, where buyer conveys the deed directly to, the seller conveys the deed directly to the buyer. And on record, it looks as though it's like any other transaction. The exchanger is the person consummating the exchange, right? So this is the taxpayer. This is the seller of the property, but also the buyer of the new property. And then there's an agreement, as you can imagine, between the exchanger and the QI. So the qualified intermediary, again, this fiduciary, this person, sometimes company, sometimes department of the bank, department of a title insurance company. There's an agreement between the parties that says, listen, we know that this is your money. We're holding it. We're going to do it in compliance and we're going to report for you to help you make sure that you don't run into any problems with the IRS. Nobody wants problems with the IRS. And these are often closely scrutinized, as you can imagine. So the exchange period is the time allotted to complete. That's that graph, that circular diagram that we showed you in the beginning. And what it is you have to identify the property within 45 days. So that's quick. But if you're laser focused, right, the way for these to be successful is to really have already identified what you want to do before you sell. Because if you wait until you sell and then start to go looking, 45 days is like a blink of an eye. It's going to be really challenging to figure out which properties you want to find. When you identify those, it must be in writing, right? So the qualified intermediary that I use is always, we always kind of circle, 42 days out. And then we send in the properties that we're identifying 42 days out, because there are no extensions. You cannot get an extension on this. If you fail to identify in the 45 days, you fail to do a 1031 exchange. Okay. Now there's 3 types of exchanges. The first one is the one you all will see most. It's the one that we see most in the residential world. The other 2 are much more, private equity, much more big portfolio type of opportunity scenarios. But the most common one we see is the 3 property rule. And that's where the exchanger, right, the taxpayer, the seller of the investment property, identifies up to 3 replacement properties without regard to the market values of those properties. So they identify 3, and then they close on 1 or 2 or 3 of them, depending on how they do it. But it's a maximum of 3 replacement properties. Then you have these more complicated, the 200% rule and the 95% rule. And again, these are what we see most often is when, there's a private equity firm that has 7 office buildings in their portfolio, or they have a number of different hotels and mixed use type of scenarios, and their fund, right, their private equity fund is expiring. So the 200% rule, the exchanger, these taxpayers may identify any number of properties so long as the aggregate fair market value of the replacement property is less than 200% of the fair market value of the relinquished. So you can only double what you're doing, right? So the exchanger may identify any number so long as when they actually replace them, they're only doubling what they're doing, okay? 95% rule. The exchanger may identify any number of properties, again, any number, as long as the total value exceeds the 200,000, but then you have to be laser focused and ultimately replace 95% of those identified. So really challenging. We're going to focus on the 3 property rule because that's the one that we see most common. What we see most often is someone has a 3 family and they identify 3 different properties, a 6 family, a mixed use, and maybe an industrial, and they close on one of those. That's the most common that we see. So let's talk about the timeline again, right? So you have 45 days from the time you sell the property to identify those 3 properties. Again, we're talking about the 3 properties, but then you have to close 6 months from the point in time that you relinquished the property. You sold that first property. These are calendar days. There is no extension available. And the time, again, day 0 is the date of the closing of that first property. Okay. Any questions? All right. So
I do have a question.
Yeah.
I just want to be clear. The 45 days starts when the sale of the property closes. Then we have 45 days to identify.
Yep.
Okay, cool. I mean, obviously, if you identify it before it closes, that's better.
Yeah. So the prudent best practice for doing these would be to go out and figure out what you want to do, right? Like, what's your next project before you go and sell? Right? So then you identify it, and then you can get it under agreement subject to the sale of the other one. Then you really aren't going to run into any of these real time constraints, because you could actually close back to back. and all of the 180 days is moot. But to be prepared in advance is highly advisable, because if we have people who we'll talk to and they're selling their investment property, and you want to have that conversation, are you aware of 1031 exchange? Are you getting out of the game? Do you want to stay in, but it's just not working for this one? And we have these conversations, and then a week before the closing, is it too late to do a 1031 exchange? No, technically it's not, but you better be ready to roll up your sleeves and really get to work, because from the point you close, you have 45 days to identify any and all of the properties that you want to potentially buy. So if you're now a week away from closing and you say, I want to double down, I don't want to pay this tax, because a lot of times what happens is people don't realize the tax obligation that they have. And we're going to go through a whole analysis of the numbers, because most people think of it as a basic gain, right? So they have their $400,000 purchase, selling it for $500,000 minus the commissions and everything else, and there's not a big tax. But when you take into the account, the amount of money that you have used along the way for purposes of, oh my God, I'm spacing on the terminology. Depreciation. Thank you. Whew. The amount of depreciation, it really makes that tax bill significant. And that's where the sticker shock will always come into play. And they'll say, oh my God, can I do something? And sometimes, that's a week before the closing. Anytime you're helping somebody sell an investment, anytime it's not a primary resident, the conversation should be had, are you aware of this, right? Are you aware that this exists? Have you spoken with your accountant as to what your taxable event is going to be? Because from our experience, it's always a lot higher than what people think it's going to be. So, we encourage you to talk to your tax professional as soon as possible. And then if you want to continue and figure out a way to defer it, let me know, and we can work on that as well. And then that keeps you involved in potential deals, for one thing, but it's also, you're a professional, right? So you're letting them know the downside of selling, which, could, not be to your benefit, right? They may say, you know what, the rents are still good. I'm not ready to pay that tax bill. I'm going to keep the property, right? But as a professional, you want to have them aware of everything, because the worst thing that could happen is, you go down the path, it's great, market's great, they've depreciated the heck out of it. They've done nothing to it. They think that they're going to have a $40,000 tax obligation, and they have a $120,000 tax obligation.
Mm-hmm.
And they look to their professionals sometimes and say, why didn't you tell me?
Mm-hmm.
And the way to hedge that bet is to simply start the conversation by, have you spoken to your tax professional about selling this property, right?
Mm-hmm.
This is not a primary residence. You are going to have taxes, and do you know how much those are going to be?
Mm-hmm.
So
or the QI too. They could talk to someone that does 1031 exchanges.
Absolutely. But but your CPA is the one who's going to tell you worst case scenario.
Okay.
Right? They're going to be the one who helped you depreciate it. They're going to be the one who has followed the line of what your potential tax obligation is going to be. The QI won't have all of that information. They're a facilitator. They're going to help you facilitate through this, but the people that actually have the knowledge of what your tax obligation is going to be is your accountant, your CPA. And it's important that they talk to them, and it's important that you all advise them to talk to them, because you are not tax professionals. Closing attorneys are not tax professionals, and we're not going to advise on that. We're going to just open up a conversation about it. So let's get a little more confusing. What about a property that you see that's run down and beat up, but it doesn't rise to the value of the one you're selling? So you have this 3-family that you bought 15 years ago, and it's appreciated in value. It's doubled. Your mortgage has gone down and you're looking to sell it for 600,000, but you find this haunted house on an awesome lot, potentially 2 lots, that is just beat up and it's only going for 350. You know, can you do that? Can you purchase that property with an exchange? Well, yes, you could sell for 600 and buy for 350 and then pay taxes on the boot, right? The boot is the difference between what is tax deferred and what is taxable. Or you could do what's called an improvement exchange, right? So you want to maximize your tax deferral, right? So you sell for 600,000, you buy for 350, right? You still have $250,000 to do repairs. So what happens is you can do an improvement exchange and your qualified intermediary becomes your construction disbursement manager in essence. So what happens in an improvement exchange, also called a construction or build to suit exchange, allows that exchanger, taxpayer, person selling the 3-family in our example, through the use of a qualified intermediary, and which could be the same person, an exchange accommodation title holder, an ET, an exchange accommodation title holder, to make the improvements on the replacement property using that exchange equity. So what does that mean? So in order to get the full benefit of the proceeds and the deferring of the taxes, you wouldn't take title. Your qualified intermediary, in this case, they would call them an exchange accommodation title holder, ET, they would hold title. So they would actually buy it for your benefit, and they would continue to own it or be the record title holder of it until you have improved it to the value of all of the equity that you have. So again, backing up, 3-family sold for 600,000. You're buying the property for 350,000, assuming all mortgages are paid off and you're not using a new mortgage. $250,000 is used to upgrade that $350,000 haunted house to the point where you would assume it's worth more than $600,000, right? So you paid 350, you put 250 into it, maybe it's worth 700. At that point, once all of the money has been dispersed from the qualified, or the ET in this case, all of those funds have been dispersed, then the title is converted back to you, the taxpayer. Does everybody understand that? So there are 3 ways you could do this. It's the standard way where you identify 3, buy 1, but you can also buy one that is valued, fair market valued, less than that's like kind, right? Because you want to get at or above the value in order to benefit you and all of the tax deferral that you can get. You can buy it at less and then use those proceeds to create the value to get higher. But you can also do what's called a reverse exchange. So again, not very often, and we'll talk about that in a second, but does anyone have a question about the improvement exchange? We don't see them very often, but they're available for our taxpayers right now, at least.
I have a question. I don't know if you can hear me.
I can.
Okay, it's Ann Joyce. And I can't get my camera to work today for some reason, but I had emailed it to you. I just did a tax exchange, a 1031 exchange on a property in Dorchester. It was my brother's property. And we sold it and he bought a house down in Harwich, a vacation home. And it was a lesser property. So he still had money left over, which I guess is taxable. My question is, he had the 45 days to identify the first property. If he bought that property, does he still have time to look for another property after the fact with that money that's left over? Or would he have had to have known ahead of time that he was going to have the money left over and identify the property within that first 45 days?
So again, we're speaking in hypotheticals, no brothers allowed. This is a
Okay.
scenario that, you know, may or may not exist, but the rule is that you have to identify any property that you're going to buy within that first 45 days,
Okay,
which is why most people identify 3 properties, because that's what you're allowed to do. So if one doesn't work out, then you have the ability to fall back on another one. Or in your hypothetical scenario, maybe you can buy more than one, right? A lot of times people want to diversify, right? They have a 3-family and they'd rather buy 3 condos in a really strong condo complex. But once that 45 days has gone by, you have to close on one or more of the ones you've identified. So if you haven't identified it, then it's not going to work.
okay. So, but you had said that you could buy land also. So could he have bought like a small piece? It wasn't a lot of money that was left over. Could he have bought a small piece of land or something with that money as well?
As long as he identified it in that first 45 days.
Okay,
Yeah. So back to the definition of like kind, right? So a lot of people call these 1031 exchanges. Some call them like kind exchanges. Some call them deferred exchanges. Most often we refer to them as 1031 exchanges. And again, we're talking about the Internal Revenue Code, section 1031. Like kind is not used as much now since 2017 because all real estate is now considered like kind to all other real estate. So it used to be where you would, you know, you would have to have a very similar type of model, right? It was a rental property. You had to have a rental property for a rental property. You could have a single family rental and convert to a 3-family rental, but you couldn't necessarily do a single family to a hotel, right? Now what they're saying is land, hotel, mixed use, industrial, multifamily, all of these separate classes of real estate are considered like kind to one another, right? So anything real estate to real estate will work under the new versions of the 1031 exchange, okay? So mortgage boot is similar to the regular boot. So to add a layer of complexity, what happens when you have that 3-family that's now worth $600,000? You bought it for $500,000 with a $400,000 mortgage. That mortgage is now $200,000, right? That's part of the equation. You can't then take that $400,000 in equity, right? The $600,000 value minus the $200,000 mortgage equals the $400,000 in equity. You can't take that equity and simply buy something without taking into consideration the mortgage. You have to match that mortgage, or you have to pay tax based on the fact that it wasn't used. Okay, does that make sense? So mortgage is, the best way to look at it is you want to have a mortgage equal to your last mortgage or a bigger mortgage, right? To benefit most, because if you eliminate the mortgage, you're actually getting the benefit of that, and then there's a taxable event associated with it. So again, $600,000, you buy it for $400,000 mortgage, it's now worth $600,000, but the mortgage payment has, the mortgage amount has gone down to $200,000. When you buy that $800,000 6-family, you want to have at least a $200,000 mortgage on it to get the full effect of the exchange. Okay.
Oops. Mark, would you not do it what if you own the house outright? Like what if you?
Then mortgage wouldn't come into play, right? You could definitely pay down your mortgage to zero, and then at the point in time where you go to relinquish it, right, and then you go to replace it, you don't need to have a mortgage on the new property. You absolutely can have a new mortgage on the new property, but this mortgage boot wouldn't come into play.
Right, but as far as taxes are concerned, it's the same thing. Would you transferring it? So if you bought something for the same amount or more, you'd be fine.
Yep. And it's
Okay.
an easier, much cleaner way to look at it as well
Okay.
for calculation purposes.
Thank you.
Yeah. So qualified intermediary, QI, right? The person or the entity that facilitates the exchange. Again, it's someone who's not related to the transaction. Can't be the real estate agent, broker, can't be the attorney. They receive a fee, so they're paid a service, and then they hold the money. A lot of these groups make a lot of their money based on holding the money, right? So as they aggregate all of these together, and if they're getting paid a certain percentage interest rate from JP Morgan Chase, they can make a significant amount of money just by what they're holding in their account. But then they get paid a nominal fee somewhere around $1,000 to do the sale, and the same with the purchase. They receive the relinquished property from the exchanger, and then they sell it to the buyer. So again, they're going to take the money in, and then they're going to deliver that money out without your client, the taxpayer, touching that money. The purchase of the replacement property from the seller and transfer it to the exchanger. So they, in essence, buy the property for you and then hand it over to you. But as we saw, they use direct deeds most of the time. So even though the qualified intermediary is, in theory, buying the property for you, on record title, you as the taxpayer are buying it. Okay. So again, relinquished property is the sold property. Replacement property is the purchased property. Okay. And that's IRS lingo. Now, the reverse exchange, which is really complicated and super rare, but if you can pull it off, awesome. So let's take an example. This strip mall that your client's been watching for 20 years just finds out that the owner died and the family wants to sell it, but they want to sell it fast. But you have this property that's tied up, locked down with a tremendous amount of equity in it, and you want to sell that and use that to buy it. You're just not going to have time. Well, if you can pull it off, and again, this is not for everybody, if you can buy that property first, right? The replacement property, the strip mall that you've been dreaming about having, if you can figure out a way to buy that and then go back and sell your property, then you can use those proceeds and pay yourself back, and it works. Now, let me see if there's another, I thought I had a more thorough explanation of that. So let's play this out. How does someone do that, right? One way is they have cash from another asset or another account that they can just pay. Believe it or not, there are banks that will lend on this. Now, your typical mortgage company, residential mortgage company, they're not going to touch this. Most banks wouldn't touch this. The folks that will lend on something like this is your local regional banks, where that taxpayer, your client, has a solid relationship, because they would understand what this person's doing, and they would understand exactly what their exposure to this is, because the person buying the property on record is the qualified intermediary, right? So you're funding it either through mortgage financing or from selling stocks or other assets, and you buy this thing outright. The record owner is the qualified intermediary. It's not you. So that bank is going to say, well, wait a second, how are we going to be ensured that we're going to get paid back? Well, the person, the consumer, your client, would sign a guarantee, right? So they're on the hook, but they would have to understand the semantics of what is actually happening. They would have to be familiar with this, which I would I would venture to say that most banks would not be comfortable with this, but some will. And again, if this is a relationship that your client has and they've got a history with them, they may do this for them, which is lend them the money in advance to buy this deal, this screaming deal that they've been dying to get, then allow them to go back and sell their assets. So more than likely, they're going to put a mortgage on that property. It's in the name of the qualified intermediary, but they're going to sign the note. They're going to sign the promissory note saying, I'm going to pay you back this $1 million, no matter what. And they would probably lien the other property that they're going to sell as well, if they're smart, right? So they're liening the actual property, but then they would probably lien the property that you're trying to sell within 180 days, right? So you buy it, you still only have 180 days to sell and replace that money. Once that money gets replaced, then the qualified intermediary deeds it back to you. So you can actually do it in reverse. I've seen this once in my 25 years, but it was really cool. Any questions about the reverse? I'd be surprised if you ever see it, but if you do, awesome. It'll be an exciting transaction. 3 general requirements for tax deferral. Again, I want to just stress that this is not tax forgiven. This is tax deferral, very similar to the forbearance of the mortgages that we're seeing out there right now versus the forgiveness that we saw back in the short sale world. Both the property surrendered, right, the one relinquished, and the property received must be held either for productive use in a trade or business or for investment. So that's where the land question came into play. Is like, if you land bank something, is it really an investment? And they've come out and said, yes, you're investing, maybe speculatively, but you're investing in the future of what this land can do. Most often what we will see in our world is the landlords, right? The person who owns they buy a condo as a young person, they move out, they rent it, then they decide they want to sell it. They convert it to a 3-family. That works out great. They want to go bigger. They convert it to a 6-family. They go bigger a few years later, and they've got a 16-unit apartment complex. That's where we would see these used most often. But for folks that own the real estate that they run their business in, they're open to do this as well. And we're seeing a lot of that with these Amazon flex spaces outside of the major corridors. The property surrendered and the property received must be real property, right? So you can't exchange something that's different. There's a 1032, or maybe it's a 1035 exchange. And that's where you can exchange life insurance policies. So that you can imagine there's a number of these types of programs where you could shift out of one asset into another without technically selling it and getting a taxable event. The same could be done with a life insurance policy. So if you have a massive cash value in your life insurance policy, rather than cashing it out, you can simply exchange it into another life insurance policy. And if done properly through the 1035 exchange, and you follow all those guidelines, then you can do so without a taxable event. But here we're talking about real property, real estate only. The property surrendered and the property received must be real property. There must be an exchange as distinguished from a sale and a purchase, right? So again, the IRS talks about these as assets being exchanged. We talk about them as properties being sold. These are assets in the eyes of the IRS, okay? And that's Papacito in the background saying hello to everybody. All right, how we doing? We still with me? Tax class still going good for everybody? All right, let's go. Whoops. So delayed exchange is another term that people used to use with respect to the 1031 exchange. So the delayed exchange is basically the same exact thing. So sell the relinquished property and within 180 days, complete the purchase of the replacement property. Simultaneous exchange is what I was talking about earlier, right? If you identify the property and you put it under contract and you make it subject to the sale of your other property, then why not close in the same day, right? Why not close simultaneously? Now, the only caution I would say is you probably don't want to do a same day closing. You want to probably give it 48 hours because you have to have the money go through the proper channels. So when you relinquish the property, that closing attorney has got to allow the qualified intermediary to sign the settlement statement and accept those funds and turn them around and get them to the closing attorney for the property that you're purchasing, the replacement property. So sometimes that takes time. I would never recommend trying to do this in the same day, only because you might break the qualified intermediary, and you don't want to do that because they have to follow the money, right? That money has to go through the channel of the qualified intermediary and then back out. Otherwise, it could fail. So simultaneous exchanges can happen, but again, give yourself 24, 48, 36 hours to make sure it works. Reverse exchange, we talked about, but what it is, it's the purchase of the replacement property before the sale of the relinquished property. So again, rare, but an interesting option if it's available for the people. And then the construction or improvement exchange. Sell the relinquished, use an exchange accommodation title holder who is the same as in the reverse, right? In the reverse, you would be using the same exchange accommodation title holder, an ET. They would hold the title in the name of their entity. They would acquire the property and hold it while the proceeds are used to construct improvements. So you'd actually have them dispersing them for you. They are holding the money. Hey, foundation's done, pay the foundation guy. Hey, framing's done, pay the framer. Upon completion of these improvements, the replacement property is conveyed to the exchanger. So once it's done, once you've spent down all of the money, then and only then would you transfer title back. Again, paperwork intensive, get a good QI, but I wouldn't imagine you're going to see something like this. But if you do, call me because it's they're fun. Now, the basic of what we're talking about here is capital gains, right? We're talking about gains. So you buy it, you bought it awesome, and it increased in value, and now you want to sell, but you don't want to pay a tax on it, right? Similar to all the people who made a tremendous amount of money in the stock market last year, right? You don't recognize a gain until you sell something, right? The gains are all on paper until you actually go to sell. And here we're talking about selling. So when a taxpayer sells the property and has a gain, that gain is subject to taxation. Question? Oh, I thought I heard someone asking. So again, the rise in value, the profit is considered a gain. But what is a gain, right? There's a lot to it. And there's a lot more than most people are aware of. So how do you determine what these taxable gains or these capital gains actually are? So you have your selling price, right? So you have your selling price minus the adjusted basis creates the capital gain. And again, don't worry, I'm gonna beat this thing to death so that we all understand it. So you have your sales price minus your adjusted basis. So what is your adjusted basis, right? This is the key to the whole equation. Your basis, the actual basis, is the amount you originally purchased the property for. But that basis can change. And we talk about basis a lot in estate planning, right? So what was the basis when someone is elderly and they want to sell the property on their deathbed to their kids, or they want to convey it to their kids? we're saying don't do that, right? Don't convey the property right before you die, because you're going to lose the benefit of a step up in basis. So your basis, a lot of these people bought their homes for $36,000, and now their home is worth $800,000, and they just want to make sure that it goes to the kids. So they want to do it right there at the nursing home on their deathbed, and they're going to create this massive taxable event that if they waited until that person died, that $36,000 basis would jump up to $800,000, and there would be no capital gain. So this is kind of going down a rabbit hole on a side note, but a lot of what we're talking about with 1031 exchanges, as we'll get into in the second half, is like a financial planning component to having, estate planning and financial advisors around these people making the best decisions to create the most amount of wealth possible. And in a scenario that you may run into, don't let grandma deed on her deathbed, because it's going to create a taxable event that might not be there when she dies, and it's easily explained. But basis, again, is the amount you originally purchased it for. So in our scenario, the original purchase price was $400,000, right? Plus the amount you make improvements to. So you bought it for 400, so that was your basis. That's your basis, your foundation. That's the amount that you're starting with. But you know what? You did the new roof for 50,000, right? You did, you hooked into the sewer line and got rid of the septic for 15. You made capital expenditures, CapEx, right? These are the amounts of the improvements that you made to the property, minus the depreciation allowed. So again, the adjusted basis is your starting point, the basis, 400,000, plus the improvements. So the higher your basis goes, the less the capital gain, right? Because you're pushing toward the gain. So you put money into the property. So you bought it for 400, but you kept pouring money into it. You got it up to 450. But then you have a slick accountant who's going to use these real estate properties. And I don't mean slick in a negative way. I mean slick and smart, well advised professional that depreciates the property. And you get that benefit every year when you pay your taxes in April, and you don't realize it until you go to sell this, if you're not really paying attention, because your basis can then go down incrementally. And now you're at 350 in your adjusted basis. So when you go to sell it at 500 and you thought your basis was 450 and you only had that $50,000 window of taxable money, it's actually 150. And that's where the sticker shock comes in. So let's talk about what that sticker shock is, and then we'll take a break and we'll go over a scenario of it, okay? So of that amount of money, so say you've got 400,000 to 500,000, there's a 20% federal tax, right? They're talking about right now increasing that to 39,000, basically doubling that, which is going to send shockwaves through the investment community, not just real estate investment, but these are also the same for stock investors. So you can imagine how many people would be getting out of the stock market the day before this goes into effect, and thus crumbling Wall Street. But so 20%, then the additional 5.05 to mass, right? So it's not 25%, but it ends up being like a 28% tax between federal and state. And then there's the 25% on the gain attributable to the depreciation. Okay, and we're going to talk about this after the break. So why don't we do this? Why don't we take an 8-minute break right now, come back at 11:08 and really dig into some fun tax stuff. Sound good? All right, so again, capital gains rates are 20% federal as we sit here right now, and then 5.05 addition on the Massachusetts. Again, we're talking about Massachusetts here. And again, 1031 exchanges can be done anywhere in the United States. So if they're selling in Massachusetts, doesn't mean they have to buy in Massachusetts. They could buy in Florida. They could buy in Georgia, right? 25% of the gain attributable to depreciation. That's the one where I would say that most people are unaware, is this one right here, right? You like that little annotation? This is the number that usually is the sticker shock. This is the one that people didn't see coming, and which is why it's important to have that conversation up front to say, have you spoke with your tax professional? Are you aware of what your tax implications are going to be? Okay. So if it's a property that you owned for less than a year, because what we're talking about, capital gains only takes effect when it's quote long term, over a year. So sometimes you see people saying, well, I can't close until, December 21st because I bought it on December 20th last year. So they want to have a year and a day, because a short term capital gain would have a tax implication of what your ordinary income would be. So whatever your tax rate is at the time would be what your taxable gain would be. And it's oftentimes significantly higher than the long-term capital gains as of right now. Again, we're talking about right now before any new tax laws are changed. So let us talk about an example. Okay, so here's the example that we have. We have this person who's selling their multifamily property for $500,000. Okay, they purchased it for $400,000. Okay, so it doesn't appear that there's going to be a significant gain, right? They bought it 14 years ago. Okay, so they didn't buy it very well, right? Let's be real about it. They haven't appreciated all that much. Maybe they bought it in 2007, right? Maybe they bought it at the peak of the market. And now 14 years later, they're getting ready to sell it. Their accountant over the course of those 14 years has depreciated the property $200,000. So what does that mean? So every year, based on a certain scale, I think it's a 20-year amortization scale or what have you. But again, this is tax professional talk, which I am not a tax professional, but I do know that with my investment properties, I have less taxes to pay every year, right? Because I have these investment properties, because the accountant is depreciating them, I get the benefit annually of not paying as much taxes that I would think I would have to pay based on the income that I've received. But this all gets paid back. So as they're depreciating it every year, in this case, they depreciated a total of $200,000 over 14 years. Okay. So what's the taxable gain is now your new basis of 200,000, and the delta, the difference between that 200,000 and the 500,000. So there's $300,000 of total gain. Now this doesn't take into account capital expenditures, right? So in that 14 years, they didn't do anything in this scenario, right? If they put on a roof and redid the driveway and redid the septic system, maybe that 250 tax basis is 275, right? But in this, to keep it as simple as possible, they didn't do any capital expenditures. They didn't do anything to improve the property. So they bought it at 4 and all they did was depreciate it. They didn't bring the basis up by improving it. They only depreciated it through their allowable depreciations, right? So now we have that $300,000 delta. What do we do with that, right? Well, 200,000 of it is based on the depreciation, right? So as you saw in the last one, depreciation recapture, right? The payback of that is at a 25% rate. So $50,000 of that is taxable now, right? Then you have the capital gains, right? So the capital gain is the difference between the purchase price and the sale price, right? You're not going to get double dipped on the depreciation, right? So you're not going to get the payback of the depreciation and then pay it again in capital gains. You're paying the capital gains in the true original basis versus the true sale price. So that's 100,000, and that's based on 20%. Okay, so another $20,000. But the state capital gains does kind of double dip, right? So they take the full delta between the sale price of 500 and your basis, right, after the depreciation, 200,000. That delta is 300,000 at 5.05 in mass is another $15,000. So when that client comes in and says, you know what, I bought this shitty, I'm going to go ahead and sell it now. The market's back. You know, I've paid down my mortgage a little bit. There's only $100,000 differential at 20%. I'm only going to have to pay around $20,000 in taxes, right? That's what the logical real estate investor is going to think if they don't talk to their tax professional, if they don't have the encouragement from their real estate professional to talk to their tax professional. Because again, we are not tax professionals. We don't want to have this conversation with them other than the fact that we know that they're missing a key component in the sale of their property. So that $20,000 that they have in their mind thinking, I can swallow that. Can they swallow 85, right? 4 times more than what they thought. And that's where the conversation comes in that says, you know, do you hate this property or do you hate being a landlord? Right? Because there's a lot of good properties out there that we can now defer this and take that $85,000 that you would have to cut a check for, which may actually take away all of what you've received, right? Or more, right? You actually may sell the property and only get $65,000 based on what you did with your mortgages, but you have an $85,000 tax bill come April. You could take that $85,000 and use it at 0 interest, lent to you by your favorite uncle, Sam, and you can use that money for something else if you're willing to stay in the game. Does everybody get it? All right. Real property being sold and real property being acquired must both be held for investment purposes, for appreciation and value, for rent, for business. Primary residence cannot be exchanged under 1031, right? So we have the situation where somebody's primary residence, again, grandma, maybe, who bought it for $36,000, and it's now subject to a massive capital gains because it's worth $800,000. She cannot use the 1031 exchange, right? Taxpayer exchanger must use the services of a qualified intermediary, right? You can't do this yourself. It can't be done do it yourself for 1031 exchange. You have to use the services of a qualified intermediary. And when we say qualified, it's really what's not qualified, right? So a qualified intermediary is somebody who follows the guidelines of the Internal Revenue Code and is not part of the transaction. So there's not a certification necessarily with the IRS. There's not a qualification or a class that you take to be a qualified intermediary. But I would definitely encourage you to do your research and make sure that the person who's doing this is going to do a very good job, right? There's a lot of liability associated with it. There's a lot of risk associated with being a qualified intermediary. In fact, funny side story is we were up for renewal on our E&O insurance like 15 years ago. And they called me up and said, we've got a problem with your application. I was like, what problem would that be? On your website, it talks about 1031 exchanges. I'm like, yeah, we have a tab on our website for real estate investors and we let them know that we're well versed in 1031 exchange and we can help facilitate those. Yeah, it looks like you're advertising to be a qualified intermediary, and that would rise your premium up, and we'd have to ask a bunch of questions, and we'd have to do riders and this and that. And I said, well, that's not what I'm doing. I'm explaining that I'm familiar with it and we can help facilitate. Take it off your website. So we took it off our website because there was some confusion on whether or not we were taking on this onerous obligation of being a qualified intermediary, which we are not. We're simply closing attorneys and seller attorneys that understand this, because there's a lot of attorneys that don't, they can't help clients with this. But we're not marketing that anymore because our E&O company said we can't. Taxpayer exchanger cannot actually or constructively receive those proceeds. So you can't touch the money. The money has to be held by the qualified. Again, rules, that's what the IRS has, rules that you must follow for success. Taxpayer must enter into the exchange agreement on or before the date of the transfer of the relinquished property. So we have to sign the agreements with the QI before we sell. There's paper trails, right? They document the timing of this. There's no room for any extensions on this. Taxpayer must identify in writing these potential properties that will be the replacement properties in the exchange. Treasury regulations require that this written identification must be made in a certain manner. The Treasury requires that it be done within 45 days following the close of the escrow of the sale of the relinquished property. I was asked to do it by email, right? You have to have the ability to trace the dates of what you're doing. Okay. The taxpayer may not have access to any of the proceeds. I don't know if I can explain this any more thoroughly. The money is not held. So the money goes from the closing attorney of the relinquished sale property to the 1031. They hold that money and then they deliver that money to the new closing. You do not have access to that money at any point in time unless you pull it out for boot, right? Unless you decide you want to keep some of that money and pay tax on it. The whole thing must be done within 180 days. And it sounds like a lot of time, but I'm here to tell you that it's not a tremendous amount of time. So let's look at the actual timeline itself. Day 0 is the day that the property first closes, right? So you have 45 days in essence from the day after the closing. So the 45th day ends on midnight of the 45th day after the date the exchanger transfers the property. So if it closes on September 12th, the 45th day is starting really on September 13th. So the closing date doesn't count, but if you're that thin and that close on dates, you know, you're really taking chances. I mean, you want to be cushioning this by 2 or 3 days either way. And the same thing with the 180 days. Again, day 0 starts the clock for both identification and closing, right? You identify on the 43rd day and you close on the 178th day after the closing, right? You don't want to be getting real close to either one of those dates because again, there's no extensions allowed. And this is important because what happens if it fails, right? What happens if you change your mind? Well, if you change your mind after the expiration of the 45-day period, they've failed to identify that, you can't get your money back, right? So day 0, you close. Day 43, you say, I can't find anything. This isn't going to work. Then you can take your money back from the qualified intermediary. You pay the tax and be done with it. But if you identify 45 days goes by, your money is locked down for the rest of the 180, whether you close or not. So if you get to a point where on the 44th day, you identify 3 properties, and then on the 60th day, all 3 of those properties were sold to somebody else, you got to wait You gotta wait because technically those properties could come back on the market. Technically, those properties are still available for you to buy. So, be cognizant of that. If it's not gonna work, exit before the 45-day window. Okay, does everybody understand that?
Yeah, I have a question.
Sure.
So you identify a property in the 45 days, you go through, something happens, seller backs out, whatever, house not available, whatever it is, and you can't close on anything. You can't find anything else because we all know what this market looks like right now. You have to wait 180 days to get that money back. And that's it though. I mean, they're going to get their money back if they can't go through with the whole 1031 exchange. They just have to wait till day 180.
Yeah, because
Okay.
it's locked down. So if you think about it, so you close, you identify 3 properties, you can't put the deals together, right? You're at day 60 and you can't put them together. Someone else bid higher than you, what have you. That money's locked down because technically those properties could spin out of whatever they're doing and you could buy them. So you can't say, oh, it's not working out, I'll take my money on day 60. You have to wait till 180. And the kick is if you closed in, say, November of 1 year, right? You close in November, you identify, you're into January, and then you can't figure anything out. You're basically locking your money down right until the time that the tax bills due. So you didn't have use for your money for 6 months, and then you turn around and have to pay the tax on it, which kind of stinks because the taxable event is the date that you sell, right?
Mhm.
So if you
Yep.
sell in 2020 and then you roll into 2021, well, you're paying your tax for 2020 in 2021.
Right.
It's kind of a stinker, but that's why you really have to be diligent and prepared to do one of these exchanges.
So
Can you
I have another
recover that
question.
money from 2020 if you end up doing, like, getting the sale in 2021? Are you
That's
somehow
it.
able to recover? Are you somehow able to recover the money that you had to pay for the 2020 sale if you're able to do the 1031 in 2021 or no?
Yeah, so I'm only talking about a failed 1031 exchange. If you're successful, then the years, they don't matter at all, right? You're just,
But the money on the failed in 2020, so say your money was locked up.
Yeah.
And you had to pay the tax April 15th because your money was locked up for 6 months. And then you do have a sale in 2021. Can you recover that money from 2020?
so you sell in 2020. The money
Right.
held by a qualified. At some point after your sale, it fails.
Right. You have to pay the tax,
Yeah,
but then you find a property in 2021.
the
That-
whole new game.
Oh, okay.
Yeah, that's a whole new ball game. That the old sale doesn't matter anymore. You've paid tax on it. You've lost the ability to defer it. Once you fail, you fail. You can't unfail. Okay.
Mark, the 40, so let's say you have, how do you, I guess the identifying the property, what does that actually mean? Because it sounds like it doesn't mean you have to have an assigned offer.
Right. You don't.
So,
You
so
have-
how do you identify and what do you send it to the QI?
Yeah.
Like here, these are the 3 MLS sheets that we want to buy.
Yeah.
Okay, gotcha.
Yeah.
And then if those 3 fall apart, if we can find another one within 45 days, we're fine. If it goes past 45 days and those properties are gone, let's say they're purchased from a cash buyer, then we're out, right? There's nothing we can do. We can't identify another property.
Yeah. So what the QI I work with suggests is, don't identify anything until
Yeah.
the 43rd day. Right.
Okay.
So do what you're going to do. Try to figure out as best you can what you're doing. Don't bother me until you have a final on the 43rd day.
Okay.
So you can be in and out of deals. You can do, you could be throwing offers out all over the place if you want in that first 45 days. But at the same token, you don't need to let the seller know that you're identifying their property. You don't have to have it under agreement. You could just say, these are the 3 properties that I've identified. And when they say identified, it's specific. I mean, it's property address, it's unit number, right? So if you can't just say any unit within this condominium complex. It has to be this unit number in this condominium complex. And it's very specific, and that's in writing, it's documented. The QI is under an obligation to hold that as like a date stamped compliance, right? So then the 47th day comes around, you're stuck with what you've identified, and you've got to close on one or more of those.
And if you don't, you failed and they're holding the money for me. Wow.
Yeah.
Especially in this market, it's so hard to even find a property. That 180 days is like 2 days.
Which is why in a market like this, you would definitely benefit by saying, I have to lock it down first. And that, again, I understand how challenging that's going to be, because people are going to say, well, I'm not taking a contingency.
Right.
But that's where you show your hand. And I don't recommend showing your hand often when it comes to the 1031 exchanges, because people start to lick their chops and think, oh, this person's going to be super irresponsible with their money because of the tax benefits. But it's also, it's better than cash in my mind, to say I'm selling a 1031 exchange property, and you just have to be prepared to, to list it to sell, and not, not be haggling over a couple $1,000s.
Right.
So qualified intermediary, again, as the Treasury regulation, it means that they are to acquire the property, exchange and transfer it to the buyer, and then acquire the replacement property and transfer it to the taxpayer. Again, redundancy is what the IRS wants. Prepare all documents required for the exchange, right? So the qualified intermediary has the exchange agreement. They have the assignment of the sales contract, and then they have the assignment of the purchase contract, right? So basically what happens is the purchase and sale agreements are signed. The qualified intermediary steps into those shoes. They become the person who's the entity that's buying and selling, in essence, where in the eyes of the IRS. So purchase and sale agreement to sell the property. I hereby agree to sell my 3-family, but both parties agree that the actual seller becomes the qualified intermediary. And the same thing for the purchase. I'm going to purchase this property, but right before the closing, we're going to assign the purchase and sale agreement to the qualified intermediary. The qualified intermediaries should be consulting with your tax advisors, right? So that they're all on the same page, like a team would work together on something like this. They execute the closing documents, really just the settlement statement. So they're the ones signing the settlement statement. The taxpayer doesn't sign the settlement statement. Settlement statement would be in the name of the qualified intermediary. When they're using mortgage funds, it gets a little bit complicated, but nonetheless, to be IRS compliant, that qualified intermediary needs to be the one signing that settlement sheet. And then, of course, they hold the proceeds, coordinate with all of the closing agents, real estate agents, tax and legal advisors. That's what a qualified intermediary does. So let's talk briefly about principal residence, because this comes into play a little bit on both sides of it, right? So, are you going to be exchanging into a primary residence, or was this actually a primary residence that you're trying to exchange out of? So generally, the property the taxpayer uses in excess of 6 months per year will be considered their primary residence. So how do we determine that? 6 months and a day, right? That's what all the people who are commuting back and forth in Florida are trying to prove, is that they're there 6 months and 1 day. So they're there more than half the year. And the reason they do that is because there's a certain amount of benefits in other states that aren't available here in Massachusetts. So the same thing applies when we're determining whether or not the property is an investment property or it's a primary residence, is to determine, are you there 6 months and a day? Many factors are relevant when you're talking about principal residence and when you're talking about trying to figure it out. And those are ever changing now with COVID, because where's the place of employment, right? Used to be, a good factor, right? We drive 20 minutes to work. That's our place of employment. Now, we walk into the kitchen and our place of employment could be anywhere, right? The company, you could be working remotely anywhere now, right? So I think we're going to see that kind of falling off. The amount of time the property is occupied is the number one, are you there 6 months in a day? But how do you really justify and verify? Do other family members live there? Is this the address used on the tax return? Very important, right? If you're trying to utilize Florida as your domicile so that you don't have state income taxes, then you better use the address in Florida as your tax return address. Same driver's licenses, more evidence that you live there, right? Using the driver's license of the state that you want to be in. Where are your banking deposits? Again, with banks online, this and that, I don't think that's going to be very helpful. But where do the bills go to? Again, online, a lot of them. So it's going to be challenging for the IRS to really pin down where people live going forward, I think. So what are some of the benefits? This is the fun part of it, right? So we did a podcast with Larry. Larry is the 1031 exchange qualified intermediary. And I did a podcast with him talking about swap till you drop. So we talked about the fact that you can defer these taxes and push them along. So you start with a condo, right? You're renting the condo, you sell it, you convert it to a 3-family. Things are going great. You convert it to a 6-family, 16. Now you've got 144 units and you've used the gains along the way. You don't actually pay those taxes until you sell. And you may not pay those taxes in one situation, and that's when you die, right? So we talked about the step up in basis with grandma on her deathbed saying, I want to make sure that the kids get the house, let's sign the deed right now. And the reason that's a no-no is because she's selling it while she's alive and she loses the ability to get this step up in basis, right? She bought the house for $36,000. It's worth $800,000. If she dies tomorrow, the kids take that property at the value of $800,000. The basis, $36,000 plus or minus, capital expenditures and such. But that $36,000 to the $800,000, if she's alone, right, she only gets a $250,000 exemption, right? Because maybe her husband already died. So there's only a $250,000 exemption. So there's really plus or minus from a $300,000 point to $800,000, a $500,000 taxable obligation that there's a capital gain associated with $100,000. Like that signature on that deathbed could have cost the family $100,000. So don't be part of that. Like, whoa, let's hold the phone. I was at a continuing ed class that talked about this. Don't sign that deed yet. Maybe put it in a trust. If that's what you're trying to avoid, if you're trying to avoid probate, maybe hurry up and put it into a trust, but don't do anything rash where it would be deemed a sale. Same thing happens with the investment. So you take that condo, turn it to a 3, turn it in, you're killing it. Rich Dad, Poor Dad, you read it, you know it, you own it. You've got 144 units. Now you're in retirement, right? It's spitting off enough rental income that you don't need to sell it. Don't sell it, right? It's worth, $8 million, but you started with an $80,000 condo. You can imagine that there's going to be a huge capital gain event. There's going to be a taxable event that's going to cost a lot of money. But if you wait and then you die, I know it's morbid, but this is estate and financial planning. If you wait and die, then the kids, your heirs, will take that property at that $8 million value. And if they sell it at $8 million and $1, then they're only going to get taxed on the $1, not from the 80,000 to the 8 million. So it's a swap till you drop is the conversation that I had with Larry on the podcast, where you could continue to utilize the IRS's 0% loan to continue to build your portfolio and maximize this wealth capacity that you can get with real estate. But if you sell it, that's when you recognize the gain. That's when you pay the tax. So you could continue to swap and do these 1031 exchanges and defer and defer and defer and defer and defer. And if you don't sell while you're alive, then your heirs will benefit by that and take full advantage of no capital gains, which is amazing. When I heard that you could do that, I was amazed. And that's where the team of the attorney, real estate professional, tax advisor, financial advisor can all get together and say, how are we going to make sure that this person benefits as best as possible? There's a strategy right there for wealth building like no other. You can go ahead.
So basically you're building wealth, not for yourself, but for your heirs. Because
Well,
you can't, you know what I mean? Like, oh, I'm sitting on $8 million and I'd like to use some of it to travel, but I can't because I'm going to get dinged. So it's really for the kids.
well, a lot of times that's the case anyhow, but
Yeah, right.
think about it from a perspective of, having 144 units with a property manager and getting,
Cash flow.
$100,000 a month in passive
Cash
income.
flow, yeah.
Do you need to sell it, right? Are you
Right.
still able to travel and do whatever you want, right? So, it's a great problem to have,
Right.
and if you do sell it, there's going to be capital gains. You could always leverage it. You could always continue to take mortgages out on it as well.
Mm-hmm.
But it's a great estate planning tool is a 1031 exchange, which I don't think a lot of people have utilized it enough in their estate plan to do that and use the step up in basis as well as to diversify what they're doing. A lot of people are afraid to be part of owning real estate. A lot of people are afraid to be landlords, especially right now. I think that's Jenny. I think that's our next class, right? Is the landlord tenant one. So we're going to talk about, what is going on in, COVID with these folks, but also it's an unbelievable opportunity for real estate investors to be, finding these folks that don't really like being landlords, and the opportunities are really out there for them. So what are some of the things that we want to be looking out for, right? How do I say this as concisely as possible? Do not mess with Uncle Sam. Do not mess with Uncle Sam. They have had every trick played on them possible. If you think you can outsmart Uncle Sam, think again, right? So if you think you're going to play games with the 1031 and you're going to sell it to your family member, or you're going to do a seller financing component to it, or you're going to flim flam partnership interests in your LLC, and you're going to get away with, truly selling and not paying a tax, think again. It's not going to work. So just be very careful when you're working with an investor who's like, all right, so here's what we're going to try to do, because what you don't want to be is part of it, right? You do not want to be involved in any level of fraud, especially when it is part of the IRS. All right, so vacation homes. What about vacation homes and second homes? We talked about primary residence. Go ahead. Somebody have a question?
Oh, no, I'm looking forward to hearing this. Thank you.
Well, it's complicated. So primary residence, we mentioned you can't do it, right? So primary residents are excluded from a 1031 exchange. I would venture to say second homes and vacation homes are as well, because they're so challenging to be eligible for this. It really, in my mind, would require kind of like an Uber wealth scenario where someone's got multiple homes, because for a vacation home to qualify in a tax deferred exchange, the property has to have been owned or intended to be owned for at least 24 months. Okay, we can satisfy that.
Mhm.
The property was rented, and again, we'll send you the slide deck of this if you want.
Awesome.
The property was rented at fair market rental rates for at least 14 days or more during that period of time.
Easy.
Easy. But the personal use of the property is not more than the greater of 14 days or 10% of the number of days that the property was actually rented out. So you can imagine it's vacant a lot,
Right.
right? Because you can't use this, have fun with it, and then say that it's an investment property. So they're gonna head that off very quickly. And it's
So if you use it more than 14 days throughout the year, like if you're down there more than 14 days?
there's exceptions where you could say you're going down there to make repairs on it. But, if it's your second home, it's like a primary. You're going to have a really hard time doing a 1031. You really have to convert it to a true investment before you do it. You
Gotcha.
really have to start renting it out, for a year at least.
Okay.
The
Gotcha.
2 years is really their unwritten rule of thumb with the intent. Like the intent was that I was going to rent this out for at least 2 years. The intent was that I was going to have this for at least 2 years. The IRS loves that 2-year intent. So, if it's a second home, for example, you've got a beach house that you've gone to every weekend for the last 10 summers, but now the kids are off in college and this and that, and you want to sell it and you want to maximize it. The best thing to do, the best practice would be to say, okay, just rent it for 2 years first. Do the best you can to get a long-term lease in there, or document, a hardcore Airbnb program where, there's no room for you to go there, right? So you can document that you've rented it significantly, and then you can capture a 1031 if they're still available in a couple of years. Again,
Right.
this all could be moot in a year.
It probably won't be. Because they want.
I really
making it-
hope. I really hope they see the value in this and they don't
Right.
just clean this slate on this. Because it's a win-win-win. I mean, the government is happy that you're helping, the investors are happy that they're getting this free loan, and the people who get to use the properties are going to be happy that there's available properties that might not be available if this isn't there. Mixed use is an interesting one, right? So what happens if, you bought that 2-family and you lived in one of them, right? And then you want to do a 1031 exchange. Well, part of it's your primary residence. So you have that exclusion and you just take the aggregate, you figure it out, and you can 1031 exchange half of it, right? You can 1031 exchange half and you can get your primary residence exclusion with the other half. So mixed use being not commercial and residential, that doesn't matter, right? If that's a full investment and there's residences on top and commercial component on the bottom, that's not what we're talking about. We're talking about mixed between personal and investment. You can do it. You just have to allocate correctly what was principal and what was investment. Again, where's the second home safe harbor? This is what we were kind of talking about, which I would encourage people not to attempt to do this because it's ripe for failure and ripe for audit. But you're limiting your taxpayer use. Be very careful of family, right? So if you're leasing it to a family, it better be fair market leasing, right? Fair market rent. You better be able to document that rent is being paid. You can't just put, the kid in the property for 2 years and have a fake lease and say that this was an investment property if you're paying all of the expenses for them. Document any amounts of time that you're doing repairs, maintenance, logs, receipts. Rent it out, right? If it's a second home, vacation home, it really needs to fit more of the mold of an investment, right? You've got to be renting it out, and you've got to rent it out a lot more than you're using it. And use written agreements and be prepared, right? 1031 exchanges will work until they're audited, right? That's the reality of it. And I think they audit a lot of them from what I hear. All right, some of the issues, flippers. Chances are it's not going to work for a flipper, right? For one thing, it's being done within a year. A lot of flips, if they're successful, it's going to be ordinary income because it's short-term capital gains. Someone buys a property, they flip it. It's done within a year. But more importantly, they never had the intent of using it as a business or a investment. So they're doing it as the business itself is flipping the property, not using the property as a business, if you follow that. So flippers, I get calls all the time. Can I do a 1031 exchange in this? Well, give me the scenario. Well, I bought it in March. We put in 50,000 and we're selling it now. No, you can't, unfortunately. Related parties, this is what we were talking about when we said, don't mess with the IRS. Don't try to flim flam the IRS because they're gonna catch you. The same taxpayer requirement, the taxpayer that's selling has to be the taxpayer that's buying, right? So whether or not you had an LLC and you are the taxpayer and you're converting it to a realty trust, or you're buying it or you're selling it in your name and you're putting it into an LLC, it doesn't matter as long as it flows down to the same taxpayer number, right? The same social security number. And that's the same with partnerships and exchanges, right? If you had a partner with an investment property and you want to do an exchange, but your partner doesn't, you can still do that, right? You just split it off. I'm taking my proceeds this way. You're taking yours this way. You're taking the tax on yours. I'm not. I'm going to go ahead and take mine and move it into a 1031 exchange. So again, we want to place emphasis on deferred, not free. This is not a tax-free exchange. Really? You're going to print that out now? 5 minutes ago. Thanks, buddy. Okay. So my son is printing out his homework right now. 1031 allows for the deferral of the gain. Again, this is not a forgiven. This is not a tax-free exchange. This is kicking it down the street to pay at some point later. However, the subsequent sale of property, the capital gain is deferred, will be recognized unless another exchange is completed. So you will pay the tax unless you complete the exchange. Okay, does that make sense? How to choose the QI? Very carefully, right? Very, very carefully. Get a referral from a trusted CPA or real estate attorney. A lot of banks, a lot of local banks have the QI on staff. I think every one of the title insurance companies does. I think every one of the title insurance companies has a department able to do it. And then, of course, there are the independent free agent types like Larry, who simply have their own exchange company. Any questions?
So I have a question. When you make your original offer, is there a particular language you should put in the offer that you're doing a 1031 exchange?
That's a great question. But again, you want to be cognizant of the fact that you may show your hand and it may affect the negotiation negatively. When you get to the purchase and sale agreement stage, absolutely. Because what you want is cooperation, right? Similar to FHA, VA, you're going to need cooperation from the seller. If you're doing a 1031 exchange, you're going to need cooperation from the seller. They have to assign the purchase and sale agreement. They have to acknowledge that this qualified intermediary is going to be the one that's dealing with the funds, that's signing the settlement statement. So purchase and sale agreement, we have addendum language in. At the offer stage, it depends, strategically whether or not you want to let them know. Sometimes letting them know actually strengthens, like we were talking about in a bidding situation. Like, I've already sold my property. My 1031 exchange proceeds are being held. This is better than cash. So to tell them that, I think would benefit. But sometimes, when you're looking at the houses and you're in those initial stages, it might actually hurt you to tell them that it's a 1031 exchange, because those that are in the know, the savvy folks that understand 1031 exchanges are like, ooh, we got somebody with some, irresponsible money that's floating around. And, and it can affect you in your negotiation.
And also on the house that you're selling, should you tell the person that's buying that house that it's part of a 1031 exchange, or?
I don't think it's necessary. It's, it's irrelevant, why I'm selling it, where I'm selling it, what I'm doing with it. But
what if you can't find and identify a property? What if it's contingent upon? Should you put a contingency on it that you're not going to sell unless you find a property, or?
It's a good question. I've never actually had that question. I've never actually, analyzed that. I'm not sure the buyer would be excited about that, but don't forget, you have 45 days after the closing. So,
Okay.
you've already closed and you could still fail. To have a suitable investment option contingency, right? To like a suitable housing, to say, I need, let's go under agreement, but I need 45 days in addition to what the IRS is giving me. So I need a 45-day window to try to find something. I mean, that could work. I've never seen it, but to say, I'm accepting your offer, but I have 45 days to find, 3 suitable properties, even though you get 45 days after closing, to
Okay.
kind of hedge that bet. I mean, it can't hurt, but I'm not sure that the buyer would be excited about it. Again, once the purchase and sale agreement is getting drafted, I would think you would want to have a provision in there that all the parties understand that the seller is selling this property under the regulations of a 1031 exchange, and buyer agrees to cooperate with any documentation necessary to be signed, something like that. But at those initial stages, those offer stages, I don't think it's necessary. I don't think it helps or hurts, to be honest,
Okay.
unless you do something like what you're talking about, which again, I've never heard of being done, but it's interesting. It's creative, especially in a market where people are dying to get your property, to have that ability to get a little bit more cushion on finding something. Can't hurt. But again, a lot of times people are at that stage where they already know what they want to buy, right? Because they wouldn't be selling their already, performing investment, right? This investment's going well. Why would I sell it? Well, because I really want that one.
Okay.
You could always extend the closing date for the buyer
Yeah.
for that, yeah,
Good.
exactly.
You
Yeah.
could, unless of course those people are getting SBA financing like I ran into. I was hoping to drag the sale. So we sold our Boston office we closed in September of 2020. So timing was great because the pandemic, the people were contracting the office space that they needed. So these folks were going from a 3,500 square foot rental office to, our 1,200 square foot, little office condo that was perfect for them. And I was strategically thinking I could just kind of push the closing out, right? I'll give myself more time by pushing the closing out. And they were getting SBA financing that had to close by September 30th. So now I have to close by next week. But we're ready. It's happening. And what we're doing is we've converted to a New Hampshire mixed use property. So we're licensed in New Hampshire now, and that's going to be the headquarters for New Hampshire.
Nice.
Yeah.
So if the person selling doesn't own anything on the property, they sell the property, the QI is holding the money. We go to buy something, we're going to need proof of funds. So do you get that from the QI? They'll send you proof of funds?
You can. Yep, absolutely.
Okay.
And like I said, that proof of funds is I think more valuable than a cash proof of funds.
Mm-hmm.
That has to be used. Cash doesn't have to be used. That QI money has got to be deployed. So if I'm the listing agent on that other one and I'm measuring offers, I like that one a lot.
Okay. And then what if there's a mortgage and it's subject to them obviously selling that property, but you're going to need, I'm just trying to think of like proof of funds, like from the lending point, even though you're using the money from the 1031 exchange, like you might not even,
the lender will look at those funds as your funds too, even though it's in the 1031 exchange. If you need to borrow money on that replacement property, so you're going big and you're taking all of your money that you won on your sale, that money is sitting there. That's going to be your cash equity. You may still need a mortgage. Well, the mortgage company will look at those funds as though they're sitting in your Citizens bank account. Like that's your money. The QI just has to shoot over a settlement. It's the settlement sheet that proves where that money is and how much is being held.
Okay. So let's say you didn't close yet. Let's say you're closing in May. Okay.
Yeah.
You identify a property at the end of March. You write an offer on the property. the house that you're selling, you're gonna pay just cash right over, so you don't need a mortgage.
Yep.
How do you give that seller's agent proof of funds when you haven't sold the residence first? That
Just
investment property?
Just like you would with any sale contingency, right? Here's the purchase and sale agreement. It's signed. This is happening in what, March, you're saying? So we're gonna sell in
Well, I'm
March.
saying like whenever we're selling, yeah, whenever we're selling, but I mean, just to give a signed purchase and sales without anything else saying that you don't own anything on the property.
Oh,
You know what I mean? Like, where's the proof of funds that like I do own it outright, they are buying it, and I don't need a mortgage, but the cash isn't at the QI yet.
it's a great question, because it's also a great question for, any of these deals. Like, how do you, we talked about that on their Facebook page yesterday. We've got a lot of interaction on it. Is, how do you win that bid? Like, what can you present to the people to make them super comfortable?
Right.
As much as you possibly can, right? I mean, if you wanted to present an offer with a purchase and sale agreement redacting the names of the people and maybe your own title exam showing that it's free and clear, I mean, why not? Like,
Right.
I'm of the opinion, the more you can hand somebody to answer every question possible, the better off you're going to be.
Yeah, because normally you'd send a letter from the lender, right? A pre-approval, or a proof of funds from the bank.
Right.
This, you have neither.
What about a mortgage discharge or something from the registry that's saying there's no mortgage on the property?
Well, that's what I was saying with the
The
title.
Title.
You could show them a title exam, but you could show them all of the above, right? So you've got a pre-approval from a lender, unless you don't need the lender.
Right.
Then you could have, you could use your qualified intermediary exchange agreement. You could write a letter explaining it. You could break it all down for them. The more information you give to these listing agents who have, multiple offers coming, I think the better off you're going to be.
And when does the owner of the investment property sign the agreement with the QI?
Before closing.
So they can do it anytime, even before they put it on the market.
Yeah. Like right
Okay.
now, I mean, we're going to sign the assignment of the purchase and sale agreement basically the day before the closing on mine.
Okay, thank you. Sorry, so many questions, but
No, it's good. I love it.
interesting.
I love it. And if any of you have questions, the best way to get me, it's challenging these days, right? Because everyone's so time blocked, but I've been using Calendly as a link. So calendly.com/mstyles. And what I do is I block out 2 hours or so a day for 15-minute increments for you, for your clients, any kind of strategy session, no commitment, no obligation. And we just chat, we beat it up and try to find a solution. So check it out. And then check out the podcast for sure, with especially Larry's 1031. He's rough around the edges, but he's very knowledgeable, and it was a fun conversation with him. Anything else? Awesome. If you're getting this certificate, don't forget to let Michaela know so she could get that right out to you. All right.
Thank you so much.
Thanks,
This was
Mark.
amazing. Thank you.
Awesome.
Thank you.
guys. Talk to you soon.